Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by Mike Bell, Global Market Strategist for JP Morgan. Hi Mike.
Hi.
And it's a roller coaster ride in the approach to Brexit. The latest polls are showing that actually the Leave campaign has a 7-point win. And this is also being reflected in the currency, isn't it?
It is. I think the currency hasn't priced in fully the impact that a Leave vote would have. In fact, I think if the polls actually prove to be correct and we do see a Leave, you could see sterling fall by as much as another 10% from where we are here. So I still don't think that the market is giving full credence to this latest poll, partly as a result of the fact that it was taken over a bank holiday, which perhaps skews the actual result.
And just to look into those currency prices, this is the forward rate of which people fix currency. Perhaps you could explain a little bit more about that.
Yeah, well, I mean, what you're seeing is that the volatility in the sort of sterling market is picking up at the moment. But really, you've seen it in the spot rate as well. It come off a couple of cents against the dollar recently. I think that what is going to be important from here is that the betting odds are still pricing a relatively high probability that we remain, even though you've seen this latest poll. I think the polls are sort of going to bounce around a little bit, and that could cause continued volatility in sterling. But, as I said, I think that you still have potential downside in sterling if we leave, and a little bit further upside in sterling were we to stay. But I think that the downside in a Leave vote scenario is much larger than the potential upside in the event that we actually remain.
And a 10% drop is significant and would, of course, have an impact on inflation, wouldn't it?
Yeah, I mean, it would be very significant in currency terms. Those sort of moves are pretty unusual. And I think the impact on the inflation outlook would also be significant. You'd see significant impact with the inflation picking up. That would put pressure on the Bank of England, given that they would sort of be caught between an environment where the growth outlook would be weaker and yet the inflation outlook would be higher, making it difficult for them to know whether to put interest rates up or indeed to cut them.
Because one of the levers that they do use to tackle inflation, and indeed one of the reasons why we've had such low interest rates for the last 7 years, is because inflation has been so low. But if inflation picks up as a result of currency weakness, then they would normally, as you say, raise rates. However, if we do get a Brexit, you don't think that's going to happen?
Well, I actually think that the sort of negative impact on growth as a result of the sort of slowdown in investment intentions that you would expect were we to leave. Also the hit to trade, given that there would be some uncertainty around whether we could actually do a deal on trading in services. I think that that sort of negative impact on the growth outlook, which we think would take UK growth down to somewhere around 0.5 to 1% growth, as opposed to the close to 2% growth that we forecast in the event that we stay in. I think that weaker growth would offset the sort of one-off temporary upward pressure on inflation, and therefore, if anything, the outlook for interest rates would probably be for a slight cut, or maybe just staying the same. But I think that the sort of weaker growth outlook would offset that one-off inflationary rise.
And let's say that there isn't a Brexit. Let's say that this latest poll is wrong. What then happens to interest rates, do you think?
Well, I think that if the UK votes to remain, then actually you're in a position where UK growth will rebound from the level that we're at the moment. You should see growth coming in at somewhere about 2% by the end of this year and probably next year as well. And in that environment, with the labour market relatively tight, we would expect interest rates to start going up probably around the sort of first half of next year, and then a sort of gradual path upwards from there.
And of course the market will rebound because of sentiment, but why will growth rebound? I mean, why has even just the threat of Brexit meant sort of reduced growth for the UK?
Yeah, well, at the moment it's predominantly coming through because of investment intentions having weakened. If you look at the Bank of England's agent scores, where they go out and ask companies what they're intending to do, what you saw is until a couple of months ago, the service sector was holding up, its investment intentions were still strong. But in the last couple of months, those have started to fall quite worryingly. The manufacturing sector had already been weak, but this sort of decline in the service sector is what's really hitting UK growth at the moment. We think that were the uncertainty to be removed and that we just carry on as we have been within the EU, that would lead to a bounce in those investment intentions. People would continue to hire, because at the moment I think that's one of the other things, that companies have actually held back from hiring because of the uncertainty, not knowing whether they'll want to be adding jobs in Europe or adding them in the UK. So I think the combination of those two factors should lead to a rebound in UK growth in the sort of months after the referendum if we vote to stay.
Mike, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.